leaders whose expertise spans global investments, infrastructure, digital infrastructure perspective, as well as innovative growth companies and private equity investment. And that includes Derek Chu is a partner with AustralianSuper, Chris Sharp, CTO of Digital Realty, and Tomer Yosef-Or, a partner with Vitruvian. Before we dive into our exciting discussion today, gentlemen, I'd love for you to take a moment and just introduce yourselves.
Yep, certainly. So Derek Chu, Head of American Real Assets for AustralianSuper. So AustralianSuper is a $250 billion pension fund, of which $80 billion is invested in the US, and then chunked down a bit more. We've got $8 billion currently invested in real assets in the US Americas. Have the benefit of both being a direct investor into specific assets. So we have direct investment in DataBank alongside Digital Bridge and Syrian alongside Stonepeak here across the Americas, as well as being a fund investor. We expect to triple in size over the next 10 years. So a lot of capital to deploy here, and really looking to put our members' money to best work in real assets across the US.
Fantastic, thanks, and welcome, Derek. Chris?
Chris Sharp, Chief Technology Officer for Digital Realty. I've been there 10 years. Company's been around about a little over 20 years. We run over 300 data centers around the world. As you saw with Bill Barney's note, we're one of the largest operators out there today that is publicly traded. Very unique kind of portfolio of assets that we've brought to market where we span both wholesale and colo. That's all heavily interconnected. And that interconnection piece is, I think, an important element that we'll talk about today around the investments and the shortcomings of that in the backdrop of artificial intelligence. But at Digital Realty, we operate in pretty much every major market around the globe, close to the city center. We don't put a lot of our capital to work out in training and in more of these disparate locations because we don't see a long-term durable workload residing there. And so as Andy alluded to on the panel earlier, we're really in this game for a long-term run and making sure that our investors in the public markets and both our JV partners have a nice return over a longer portfolio time frame.
Excellent, thank you, Chris. Tomer?
Yeah, perfect. Tomer Yosef-Or, I'm a partner at Vitruvian Partners. I lead three things at the firm. I lead our North American efforts, our Israeli efforts, and our enterprise infrastructure and cloud thematic at the firm. Vitruvian is a global firm. We are headquartered in London, but we have 9 offices around the world, including 5 in Europe, 3 in Asia, Shanghai, Singapore, and India, and then our beachhead in Miami, which is where I'm based. We manage about 20 billion of assets under management, and our latest fund, which was Vitruvian 5, is 8.2 billion. And we write checks anywhere from 75 million on the low end to about $1 billion on the high end. Prior to joining Vitruvian and helping to head up the North American efforts, I was a partner at a firm called Abry Partners based out of Boston, and I led a lot of the investments around digital infrastructure, so dating back to investments in CyrusOne, one of the original investors there and on the board, to hosted solutions, Q9 Networks, Exand, Root Data Centers, Telex, which you guys are very familiar with. So those are some of the investments I've made over the years. And really, the key thing that drives my investing activity is 3 key themes: the proliferation of bandwidth, the expansion of public and private cloud, and ultimately digital transformation. I've just been able to benefit from these major trends for the last 20 years. And what we see today is that it's not looking like it's going to stop anytime soon. So it's actually quite an exciting time to be investing in this space and deploying money behind internet infrastructure and AI, as well as what we call the picks and shovels of AI, which we can talk about a little bit today.
Excellent, thank you. So right, that's what we're here to talk about, picks and shovels. So look, I think as we've heard, both with Bill's discussion earlier, but also what we've seen in our industry, private capital has truly been the driving force behind the explosive growth in digital infrastructure, helping it become truly the backbone globally of our digital world and what we look forward to with AI and how it impacts our lives. But as AI transforms and reshapes the futures, the question really is, Where are those next areas for growth? Where are the next big plays from a capital investment perspective in this rapidly evolving landscape from a private equity, an institutional investing, and even a corporate investing perspective? To set the stage, before we jump off, let's take a look at some of those shocking figures I think we heard earlier today, which are incredible for us who've been in the industry for 25 years to see this, right? Our global AI data center market is set to grow to over, $933 billion just by 2030 alone. But I think what was even more surprising to hear earlier is the staggering $6.7 trillion by 2030 in infrastructure investments required to meet the needs for AI and cloud compute power globally. And on the capital front, just in the last year alone, 2 years alone, we've seen such an incredible growth from $108 billion, which was more than 3 times the previous year before, 2024. Over the next 5 years, just in the US alone, data center investments are expected to exceed $1 trillion alone, plus another $1 trillion just in supporting new power infrastructure to power all of that. These figures not only illustrate the immense growth potential, but also the strategic imperatives that you as investors and as operators for how to innovate and scale in this space. So maybe Derek, with your incredible role there with AustralianSuper, we're at a $280 billion fund. Would love to get your perspective on what do you see as the next big investment opportunities for private capital to fund AI growth and to fund growth in adjunct areas that are critical for success?
Yeah, I think as an institutional investor, we're kind of trying to put large investments into real assets and try not to lose our members' money, right? So kind of similar to, I think, what Tamer's mentioning about picks and shovels, we're trying to invest in the hard assets that won't lose us money. And so I think there's just this huge convergence around the data centers themselves. Sure, we can kind of look at, okay, the top markets, the best deployments there, whether it's cloud or AI, look for inference nodes. But I think that it's just really interesting that as a lifelong infrastructure investor, you can also look at it from the energy perspective and go, well, you know that all the utilities are struggling to scramble to get enough power connected to all these data centers. You can invest in utilities and get a regulated return and still have that exposure to AI. You know that you're going to get a return on rate base. The rate base is going to grow really quickly. You'll get a great return on that. There's other bits in the power space. We're looking at investing in solar, investing in batteries, fuel cells, which kind of not obviously the lowest cost answer to solving power, but if you get folks connected a year earlier, that's huge, right? So we're actually thinking on both the data center deployment side as well as being able to put large investments across regulated and contracted returns on the energy space.
Chris, I'd love your perspective on that.
Yeah, no, absolutely. We've always watched it like power is a binary thing, and I think people understand that in this room, but like without power, you can't have the data center, and there's derivative impact down the line on that. And I think one of the things that I would echo in Derek's sentiment is we deal a lot with these utility operators where we master plan and market, where we build out a campus, right? We're very different in the way we view how we put our capital to work. So we want a long-term durable environment with durable workloads and durable customers inside of that environment. And I think that represents a very unique opportunity to the utilities, to all the different power sector elements coming to market, that they want a risk-adjusted customer base utilizing the power that they're bringing to market. And I think that's where we spend a lot of time with these utility operators, where there's a lot of companies that are upstarts with limited background and limited depth in understanding the amount of capital required to bring a gigawatt of demand into the market or a gigawatt of power into the market. And I think finding that balance and the right types of technologies is everything. And I've been talking for many years about small modular reactors and how elegant it would be to tuck it into the grid, but there's different opportunities to put your capital to work, but you always want to be aware of the consumption, make sure that the customers that are consuming those are balanced out as well. And that's something that we've been doing for some time and working with utility operators and actually investing in some of the substations and making sure that we can get the distribution, because it's not just about generation, it's about distribution and the consumption of that. But absolutely echo the sentiment that you have to find that balance and find a way to operate not only for the new electrical production, but then also how can you do it in a green manner. And so we actually operate over 1.5 gig of wind and solar. One of the largest operators of some of these different types of environments for power generation, but that's something that we've been watching, that longer term demand, because a lot of our customers also have very strict science goals for how do we reduce carbon footprints, because I think that's a subtone that's hopefully you heard throughout not only PTC here, but PTC in Hawaii, is that we have to find a way to service our customers and put our capital to work so it's not only getting returns, but there's also a green aspect to that as well.
So that's rather interesting. Well, I'm going to pick up a little bit more on that. Tomer, I'd love to hear your perspective. I know you have a completely different view in terms of your prioritization for investments.
Yes.
Could you speak a little bit about that?
Yeah, sure. So we come at the market quite differently at Vitruvian, and what we really look for starting off is what we call a dynamic situation. And for us, a dynamic situation is something that is driving some sort of change in the micro, where a company that we're spending time with is ultimately a leader in. That change could be driven because of regulatory, compliance, technology, human behavior, environmental. And that change ultimately has long-term compounding tailwinds that are tied to it. So we spend a lot of time really identifying that dynamic situation. We then pick the company that we think is a leader in the micro, and with our global footprint, we try to help them become a local market leader, but ultimately a global champion. And when we get that two-knock punch is when we ultimately drive a real outsized return for our investors. And I'm talking about 4 to 10 times your invested capital. That's what we strive for, right? And so when you're looking for that type of dynamic situation, that type of a return, you can't just be investing in the asset-heavy side of the market. You got to also find investments in the asset-light side of the market. So particularly to picks and shovels and how we approach it, right now we think the networks themselves are undervalued. AI, all this data center demand is driving significant amount of data transmission that's taking place. And if you look at networks and bandwidth historically, that's an interesting market because from our perspective, you always had price compression on bandwidth driven by high volume. We think that phenomenon is going to change over the next 5 years, particularly with some of the stats that you mentioned, Lynn, that are going to drive growth in data centers. And so that's an area that we're focused on today. And one investment that we recently led, it's actually an Israeli-based company called Cato Networks. We led the Series G, is a company that's playing straight into that. It's a network-oriented business with what they call SASE, and that's Secured Access Service Edge. So what we're seeing is not only is there a lot of demand for network and bandwidth, but also on top of that, cybersecurity is a big, big concern. And you have the Palo Altos of the world and the CrowdStrikes that are providing services on top of that. But there isn't a business or a company that does that in one painted glass. Cato Networks does. And so just to give you guys a sense for this business, it's north of this is public information, it's north of $250 million of revenue, and it's growing 40% a year. And so we get behind those types of companies, which are the picks and shovels of what's happening in AI. They're the beneficiaries. We pay up for them. We stepped up with our valuation. It's a revenue multiple, maybe as high as some of the data center multiples on EBITDA. But the way we get comfortable with it is the long-term growth trajectory, this change that's taking place in the market, this dynamic situation that's driving 40% compounded annual growth, you're ultimately bidding down your multiple very quickly, even though it was very high to begin with. And that's what we are very good at is actually one of the things Derek and I were talking about before we got on stage was we're very good at valuing on our side, and we could talk more about it, Lynn, if you'd like, valuing growth than margin.
I'd love to explore that a little bit more before we go back to we're going to touch on sustainability in a second. I think that's a really interesting point here where you take, Derek, in a much different time horizon view, and you have factors to look at which are significantly different than Tomer, as you look at that. Maybe let's dig into that a little bit, because as we look forward, I imagine, Chris, where you're going too, you're going to have different indicators for what looks like a great investment for the future.
Sorry, on...
How you're looking at long-term investment versus...
Oh, yeah, sure, certainly. So, look, I think like our fund's tripling in size over the next 10, 15 years. So if we do exit, that's great, but then I have to find somewhere else to put the money. So it is kind of a different perspective from that side. I think I can link it a bit to sustainability. Like at the end of the day, AustralianSuper is legislatively required to singularly focus on delivering best returns for members. So why focus on sustainability? And we think of it quite pragmatically as well. You're not, like, it's a nice thing to do renewable energy, but the reality is that if you're going to own these assets for 10, 15, 20 years, actually having that kind of that kind of powering your assets is actually protecting you from stranded asset risk. So, you know, if you need to think through not just building it and selling it within 2 years, but you may own it through the contract life, you'll need to recontract it. You'll need to improve the various parts of what you own. You want to actually have all the options on the table with respect to. It'll be more interesting for folks to recontract with you when you get through to the next contracting period. Now, that might be optionality simply as you're connected to the grid. You might have kind of direct PPAs. We try to move away from using credits over time. It kind of is okay for now, but you do want to actually link to physical power. And I think if you kind of think of microgrids as starting with gas and having the option to move over to hydrogen, like that all kind of makes us feel more comfortable as a steward of our members' capital to be investing over the long term in assets that have that kind of flexibility.
Yeah, I appreciate that. Chris, I'd love your perspective on what do you see the role of private capital in supporting sustainability and renewables?
Yeah, we absolutely welcome it, and I would echo your sentiment, Derek, that the credits are one thing, but getting closer and closer where the power generation is extremely important. And there's a lot of in the global market opportunities for private equity to come in around these solar, wind, and other generation kind of capabilities that I think are emerging rather quickly. I'd also say I think this room would appreciate that the data center is the point of integration. Like it doesn't matter if it's AI, if it's cloud, if it's networking. That's where all of these elements come together to be monetized. And so I spend a tremendous amount of time not only thinking about what's happening now, but what's that future monetization event going to be as you start to watch these technologies mature over time or become technologically obsolete over time, because there is a transition that we're in the middle of. And AI is an and not an or at this moment in time. But AI will be an or on some horizon. I'm not saying it's tomorrow. I'm not trying to be an alarmist, but we constantly are looking at how to leverage. I mean, in my view, and I wish Andy was still here, we have one of the best balance sheets in the industry, right? We have multiple sources of capital. He had referenced our hyperscale fund. Why we've done all of this work is it takes a material amount of capital to build out these environments for what this next iteration of growth or margin would be. And hopefully you can marry the two together. And so we're always looking at how we balance our direct investment with our fund and our overall public sector and being able to raise funds against that and balancing the true returns you can get out of that. And I think that's where one of the elements that I would emphasize is the networking piece is extremely important, and it's misunderstood at this moment in time. I've built my career building the first private access to the largest cloud between one of the largest financial customers in the world. And that's what we created, what you see today is this hybrid multi-cloud. And so what we saw at that time was, and many of you probably remember this, and I was giving Steve Smith from Zayo a hard time, we lived through as the cloud friend or foe. That was a big deal. Right? And so when we started to understand that you could have private access to a cloud and put a private deployment to enable hybrid, the same thing is going to happen with AI. right? And so watching how these networks are not only intelligent for SASE and some of these capabilities, but what are those destinations? And Bill Barney said something with these cables. They're all going to eyeballs today. They could go to GPU arrays. They could go to different destinations which are high value for how this tremendous amount of compute, which also requires a tremendous amount of networking, come together and communicate logically. And so I've been talking about for some time these private AI exchanges. It's absolutely required. You're going to have private access to these massive GPU arrays where there's going to be amount of throughput required is 10 to 20x anything we've ever seen. So it's going to require a different type of optical interconnect. But these are the types of environments that I not only work with, how we support these customers directly with our own investments, but also who we want to enable for our customer base. And so there is a huge opportunity in the way that the fundamentals, and I absolutely worked with Vint for many, many years, a long time ago, how the internet was built and how that scaled, and some of the work that Troy, Vint, and that team were talking about earlier today. You're going to see another step function with artificial intelligence because we're still at the very early stages. And so, dig into beyond just training inference, right? And we're still early stages, but inference is going to be a critical factor. And then monetization. If you're not watching how it's going to be monetized, you're going to end up in a bad place. And so some of the things that we're always watching is the rate of silicon is much, much faster. Right? Like I would impress upon the group here that watch the rate of silicon improvements where you can see 30x improvements in 12 months. Is very, very different than the rate in what we look at in concrete. And when we build these data centers and the durability of that data center and the viability of that data center, balancing those things, it's not easy, but there's going to be winners and losers against that. And that's where we're constantly watching how we apply our capital against those kind of thematic elements. But very excited about what it represents, not only for growth, but also margin and durability. There has to be a moat. There's lots of activity in the market today that I don't think has a true moat, but we are always looking at how we can operate, and being an operator and one of the few that have over 3 gigawatts under operations today and have another pipeline of 5 gigawatts coming online, and being able to look at and understand what it takes to operate in this horizon, but in the next 2 or 3 horizons of the advancements of silicon and networking, that's what it's going to require to be successful over a longer term duration.
So fascinating. So AI interconnects. This goes all the way back to days of telex, right?
Yeah, 100%.
It's basically next generation of telex. Tomer, tell me. I'm going to put you on the spot on that. We didn't talk about this question, but that's really fascinating. Where do you see that going, and where you would invest as it relates to AI interconnects and the security around that? I mean, I got to imagine there's a lot of interesting opportunities there.
Yeah. No, I'll take it in a slightly different direction, Lynn. But I think it ties to the network, right? And it ties to the massive demand that's coming from AI. So we talked about Cato as one area, and SASE and the security on the network. And it's great to hear you say, Chris, you validated that. So that makes me feel better about the investment that we made 3 months ago. But at the same token, there's other businesses that we're spending time in, particularly around storage, for example, right? And then the transmission of data to the large language models. And so there's 2 companies in Israel. We haven't invested in them just yet. Some of you may be familiar with them. One is called Weka, which is doing quite a lot with Tesla and the likes. And then there's another one called Vast. These are pretty sizable businesses that are really, really good at storage. And they're changing the paradigm of storage and data transmission in an AI world, effectively away from what you would consider to be a pure type storage provider. And these are really interesting businesses because they're actually doubling in size at scale every single year because of the trends that we're seeing in the market. And so, take Weka, that was a 50 million revenue business about a year ago. It's now doing 100 million, right? And you could see how it becomes 200 and 400 and 800 and ultimately $1.6 billion plus. And there's a lot of value to be attributed to that kind of trend and that long-term tailwind. And so I think the way we think about investments and growth is at any given time, we value growth, and we have a formula for this, at 2 times the value of margin. So when we look at businesses, everybody talks about the rule of 40. A lot of you are familiar with it, right? Which is the combination of your growth and your margin. And are you above 40%? we attribute double the value, sometimes 3 times the value for the growth than we do for the margin. And that's how we get comfortable ultimately paying these big revenue multiples for these businesses that are doubling, compounding at double the rate every single year. One of the things we lean on is something called the PEG ratio. Again, I'm getting a little technical here, but it's really the price that we're paying for a business versus the growth that that business has. And that allows us to basically level set all the companies that we look at in an industry that are experiencing this dynamic situation and this hyper growth and say, this one is undervalued and this one is overvalued. And so we want to lean in more on this particular opportunity than this one. And yeah, that's how we are identifying assets in this space. I mean, there's so much to do here because the change is so big. The capital deployment into hard assets that, you know, digital is doing and AustralianSuper Fund is contributing to is supporting our ability to come on the fringes and see these amazing, beautiful businesses that are asset light that are doubling in size every year.
So what I love about this is the balance, right? You're providing balance to the market, balance to entrepreneurs, balance to sovereign funds, to those of us who have pension funds, right? So, but it's unlocking the opportunity for innovation in a way by providing capital both on the infrastructure side and also for, as you measure, for growth, for true innovation. What are some of the interesting things you're seeing in that collaborative environment? I think partnerships we heard about earlier is a critical element of that. But I know that, for example, Derek, with Australian, you have taken a direct active investor role, which is unusual, isn't it, from an institutional standpoint?
Yeah, I think what you're seeing is you've had a number of large institutions look to do direct investments and only do direct, and then you've had other institutions go, okay, we're only going to partner with folks. I think kind of there's a growing realization across the institutional investor landscape that firstly, to go direct, you need to write very large checks because to do that you need an internal team, and to justify an internal team, effectively you need to be making savings versus giving it to an external party, and so it needs to be large checks. So there's a long tail of folks who would like to do that but don't have the size of fund, and so they will continue to look to do funds, but folks like us, where it's more stable, lower risk, you know, we feel like we have the capability to put that money to work. Now, I think it's interesting where you're seeing a lot of institutions go, okay, we've had a lot of success doing that at the lower boring end, but once we kind of drift into things that are more operational, have more go-to-market risks and that kind of thing, being a minority investor and trying to do it ourselves is actually quite difficult. And so what you are seeing is more and more folks go, look, we can write those big checks, but we'd really like to partner with the likes of large general partners and put money in their funds and trying to get kind of co-invest, co-underwrite alongside them. So that allows us to get the high returns, average down fees, and you're seeing a lot of folks like ourselves, like some of the Maple 8, the large Canadian pension funds and other sovereign wealth funds look to do that. I think you're also seeing a lot of institutions just approaching folks directly and just saying, look, we know you know how to operate, we've got a lot of capital, can we find a way to go forward? And I think what's clear is that there's just not, there's so much capital need on the hard assets, right? Everyone's trying to scramble to actually get the dollars out the door. The separately unanswerable question, I don't think anyone has a good answer, is who's going to buy it at the next turn? We'll figure that out over the next few years, but yeah, like right now, everyone who looks a lot like us is saying, look, there's something going on here, we want to invest with the right people, you know, just, you think you know, but why not go with folks who are actually spending all day long thinking about this and kind of monetizing these assets and figuring out the development rather than saying that, hey, as an institution with 12 people, which in New York, which is probably one of the relatively larger direct institutional teams, is still pretty small for the amount of money we're trying to put out the door.
Excellent. Chris, what is your perspective on that?
Yeah, I completely agree. It takes partnerships, right? And we've talked about many of them publicly in different partners for different markets. We're one of the few global operators where there's a couple of benefits associated with that. It's not only the different types of partners you can attract and different type of capital within that market and appetite right? Because I think there's different types of private equity funds that have different appetite for certain returns and over a certain profile, but we look for that longer term investment. I would also say that, one of the things, not only in partners in financial aspect, but also partners in technology, right? Where we've taken a firm stance since I've been here 10 years, where I'd rather invest in my customers as opposed to competing with them. So said in an industry kind of lingo is we don't go up the stack. And so we're always watching how we can work with some of the most performant providers, such as networking, Cato, or Vast with storage, because performance storage is an absolute critical component. Happy to go into detail around that. As GPUs become more performant, you can't get enough data to them, and so you have to put more and more either frontline memory in front of that to be able to utilize that compute cycle. So there's a lot of gaps in the overall technological stack that are getting a lot of pressure on them. But going back to operating a global platform with 300 plus data centers, we really embrace our customers and start to understand what are the technologies that they're going to be betting their business on to build these solutions or capabilities where they can design once and deploy many. Very similar to what you were saying, Tomer, is where you want to see a technology kind of be best of breed in a certain sector and then start to bring that out globally. We see the same thing from a validation of customers. Being that we support some of the largest hyperscalers on earth today, absolutely love them, but they're not the easiest to deal with because they have their own R&D, they build their own facilities, and so we're at that intersection point of providing them a place where they can monetize those capabilities. And so watching how that gets vetted and watching the key technologies come to market, and I'd be remiss, and I'll just mention it at the highest level, cooling is extremely important. Bill Barnley put a slide up there talking about the different types of capacity coming online, if it's 8 to 10 kilowatts today per rack, and you see a roadmap getting up to 150 kilowatts. We have been engineering for that and planning for that for some time now. And so we've actually pre-invested in a capability called HD Colo. We've brought a bunch of rear door heat exchangers and direct liquid to chip technology providers. So we provide a lot of those capabilities and pre-bought them because of the supply chain constraint. Because at the end of the day, we want to allow our customers to get into the facility as fast as possible to start to, be able to leverage and monetize their investment in their chipset or, storage or whatever capability they're bringing to market. And then conversely, we also get to start monetizing the power that we've brought to market, because power is the product. How you do it more efficiently, how you do it at a larger scale, how you deliver that, that is the culmination of what my job has been over the last 10 years in working with these utility operators.
Such a great point. Power is the product. Tomar, it'd be interesting to hear your perspective on the partnership and the collaboration side, both from an investment but also from a technology collaboration. I think that idea around, for example, innovation in liquid cooling or some of the the stack or ecosystems innovations. How are you looking at that, and how are you collaborating with Digital Realty and others to identify how to help accelerate those innovations?
Yeah. So probably not the best area, but let me tell you of one area that I can talk to as it relates to that particular question, which is, I haven't mentioned this investment that we made about a year ago in a company called Options IT. In our thesis there was, this is a business that provides global capital markets infrastructure to big banks, asset managers, and hedge funds. And so they have over 70 point of presence around the world that are very close to key exchanges. And by exchange, I'm talking like equity exchanges like the London Stock Exchange or the New York Stock Exchange. And they service the likes of Bank of America and Jefferies and these big investment banks, institutions, and their trading needs. And one of the things that we saw there that we really liked about it was that banks historically have been reluctant to outsource. Outsourcing isn't a new trend, right? We've all been benefiting from that for many, many years. But banks themselves have always been behind the ball. And so that trend is starting to change as regulatory changes are happening, compliance is becoming more complex, shortage of talent is identified in the market, plus it's hard to retain talent. And therefore, a lot of that business is coming to Options IT. But Options ultimately is getting all of its infrastructure from a data center perspective, from the likes of Digital, from the likes of Telex, being close to the meet me rooms that Telex had, but also getting that from Equinix. Those are the two major providers from an infrastructure perspective. And then they provide their services on top to their end clients. And so we see a lot of collaboration from that perspective with Chris and his company, but less from a collaboration on the cooling and things of that nature that
Which
they
is
do.
where you, right, and you're further down in the stack, and your enablement of the power and the cooled power and everything that's needed to run and operate, absolutely. So as we look forward, and we're going to be wrapping soon, but as we look forward, I would love your perspective for the audience on where do you see, all three of you, the greatest market opportunities across both geographies globally, but also across interesting segments that you're seeing? And maybe Derek, we'll start with you.
I might attack it slightly differently. What I'm actually really excited about is that if you think of, as both a direct and indirect investor, we have an enormous amount of structured and unstructured data from all the companies that we own and the partners that we invest with. And if you can pull that all in and get kind of global insights as to what is happening, and I think we're starting to see some of that where we're working with various providers to take in all the reporting data from our GPs, for example, and you can actually pick out trends. You know how certain GPs mark their values. Some might mark them a bit more aggressively, some might not. I find it really fascinating. Like if you think of, like in our home market in Sydney, we own the electricity distributor, we own some toll roads, we own the port, we have a stake in the airport. We have all 1/3 of the telco towers around there. What I'm really excited about is just being able to kind of grab all that data and actually pick out the trends. And very hard, historically, to pull that all together and put some analysts onto it. You're not going to find much, but I'm excited there. I think to answer your question, I suspect where AI goes is it becomes quite national in terms of kind of from national security and the like. And I think that there is actually something interesting for someone like us, kind of a trusted country, trusted partner with respect to being part of the Five Eyes Alliance, et cetera, that kind of allows us to invest in things that others may not be able to.
Excellent. Thanks for that. Chris?
I appreciate it. Three simple things: power, cooling, and global. I think power, not only in the generation and the transmission and the different technologies required, I think hopefully you've been tracking a lot of the batteries. Batteries are getting tremendously cheaper, and so that's opening up a lot of avenues and opportunities for different kind of power storage environments within some of the grids that are heavily utilized. I would say cooling, as bad as we think it is today, the thermal dynamics associated with some of the future silicon that's coming to market it's daunting, right? And you hear certain adages where even Jensen at GTC talking about, upwards of a meg rack. That's very, very hard to do from an engineering operational perspective. But cooling technologies are going to evolve rather drastically. And then global, I think we always watch, and one of the things we look at is, our platform and our capabilities. The actual services we deliver on a standard basis look the same, but the actual technology within them, because some of the markets you can't use water, other markets where you can use free air cooling, the design of the data center drastically changes, and the PUE efficiency associated with that changes as well. And so, the backstop of a lot of the talks today, AI is extremely power hungry. You can't solve everything in one market. It has to be distributed, and you have to do that in the most efficient fashion. So I would say all of that is backstopped by people, but you can't really, people are the component that make it actually operate. So I would say that's where I'd watch in the markets going forward.
Power, cooling, and global. Excellent. Tomer, you want to bring us home?
I'll try. I'll pick it up on the global piece because I think that's very relevant for us. Right, with 9 offices around the world, we're always looking at globalizing themes. We're big believers that themes globalize, right? Something that starts in the US eventually makes its way to Europe and then into Asia. So one of the areas that we really like, and therefore we set up an office there, is India. We think India is emerging in a big way. Data center demand there is expected to double, so that's quite interesting for us. And then you start thinking about all the picks and shovels in and around that demand from a data center perspective, and that gets us pretty excited. So we have a full team on the ground in that market, and we think there's quite a bit of opportunities there. I would say if the US, or if something would be in the 5th inning, India is really in the 1st inning. And that's, for us, that type of dynamic situation drives what we look for, which is an outsized return, ultimately, to our investors, right? I was talking about that 4 times to 10 times your money. It's hard to find that in a market that's already stabilized.
Fantastic thoughts. And with that, we're going to close our session. Please join me in thanking these wonderful panelists.